Hello, everyone, and a warm welcome to this ICAST webinar, the third in our series of autumn tax updates for our members. For those of you who don't know me, my name is Chris Campbell, and I'm Head of Tax Practice and Owner-Managed Business Taxes here at ICAST, and I have the pleasure of being your host today. In this series, we have provided an essential update of the most recent tax developments. Part 1 of our series covered the latest owner-managed business taxes and employment taxes updates. And Part 2 covered more general tax updates following the UK budget on the 30th of October. If you missed either webinar, you can of course catch up on demand by going on to the ICAST website and searching for Autumn Tax Update Part 1 or Part 2. But in times of devolved tax administration, the UK budget is only part of the picture. So in today's webinar, we will concentrate on the changes you need to be aware of following the Scottish budget on the 4th of December and the Welsh budget on the 10th of December. Over the next 55 minutes or so, we will explore the various announcements, not just for income tax, but in the other taxes where the decisions are taken by the devolved administrations. To help explain and help us understand the changes and the challenges and the opportunities for you to be thinking about when talking to your clients, I'm delighted to be joined by my colleague Justine Riccomini, who is our Head of Employment and Devolved Taxes here at ICAST. Whilst Justine is a long-standing, recognised expert in the employment taxes space, she is also very well known and respected for her practical experience and deep technical knowledge of the devolved taxes from the outset. Indeed, Justine has worked on everything devolved tax in a Scottish perspective of the evolving Scottish taxes landscape since joining ICAST. She works closely with the Scottish Government, Revenue Scotland, the Scottish Fiscal Commission and the Scottish Parliament Information Centre, or SPICE, on all aspects of devolved taxation in Scotland. More recently, she's also expanded her role by engaging with the Welsh Government, Welsh Revenue Authority and other stakeholders in Wales as the Welsh Government seeks to expand its devolved taxes remit. Before we begin, just a few housekeeping matters to remind you of. You can submit questions at any time using the Q&A facility, which can be accessed at the top of your screen. Questions can be submitted anonymously. We'll be saving all your questions until the end of the webinar for the live Q&A session. Please also join the conversation today through the chat box accessed at the top of your screen. This allows you to comment or discuss with fellow attendees on matters covering by this webinar. While both the Q&A and chat facility should be available for all virtually attending webinars watching live, occasionally due to your own organisation's policies or the browser you're joining from, it is possible that one or both of these might not be available to you. We are, of course, recording this webinar and will make it available for on-demand viewing afterwards in case you want to refer back to it or share it with others. And the slides will be available on the events page on the ICAST website under the events listing after the webinar. We look forward to receiving your questions throughout the course of the webinar, and of course we'll try to get through as many as we can. But as we have two devolved budgets to cover, there's a huge amount to get through, so I'll hand straight across to Justine to get into the detail of today's webinar. Justine, it's over to you.
Thank you, Chris, and hello everybody. It's a murky old day here in the Pennines in West Yorkshire. I hope the weather is a little bit better with you where you are. So I'm just going to run through some topics for today. Essentially, we're going to cover the key points that come out of the Scottish and the Welsh budgets, and then have a look at some questions, hopefully, if we've got time, because I thought we were going to basically have not very much to say, but actually quite a few quirky bits have come out that I want to cover off, so that's good. So I'll start with the Scottish budget, and I'm just looking for my Oh, yes, here we go. So the Scottish budget, essentially what I'm going to do is cover all of the taxes that are listed on the slide, give you a bit of an overview. I'm going to include a few bits on council tax and non-domestic rates. And bizarrely, even though national insurance contributions is not a devolved tax, I am going to mention it in this seminar. So I'm just going to talk about a little bit of potentially planned legislation that's coming in and that might come in, and then talk about the tax strategy document that was published alongside the budget. Okay. So I'll just move on now to the overview of the Scottish budget as a whole. So on the 4th of December 2024, as we know, the Scottish Finance Minister Shona Robison set out her draft budget proposals against a backdrop of the announcements that were made by the UK Chancellor of the Exchequer, Rachel Reeves, on the 30th of October 2024. So Shona delivered her budget for Scotland, starting with the spending commitments before moving on to the tax raising part of the budget speech. And alongside this, the government produced its Scotland's tax strategy building on our tax principles document, which is the first time that they've ever produced the two documents at the same time. So overall, the most interesting thing about the budget was that it appeared to be the first time in a few years that tax rabbits were not being pulled out of hats, which was something of a relief to us tax specialists. And we could ask ourselves why that was the case, but clearly it was because there was little room for manoeuvre within the amounts of money available to them. And in addition to the items listed on the last slide, those who listened to the budget announcement or saw the news will also have learned that the government promised to mitigate as far as possible the impacts of the two-child limit. And according to the Fraser of Allender Institute, which is part of Strathclyde University, this was clearly a late addition, and one which has not been included in their own or the Scottish Fiscal Commission's analysis, though it might end up costing the Scottish Government as much as £200 million a year to remove that cap. So if the measure is brought in UK-wide on the two-child cap, they won't have to fund it from Scottish revenues raised from devolved taxes measures. So there was a vague mention of a 2026 start date on that, and we'll have to watch and wait on that score. So I would say that whilst we didn't have the blatant shock tactics of last year's unfunded council tax freeze and the introduction of yet another income tax band to contend with, there are still a few bits to be concerned about, as £200 million in the Scottish budgetary framework amounts to a lot of money. One surprising issue which has emerged from the Scottish Fiscal Commission's analysis is that despite the cost of living squeeze, mortgage rates rises and gas and electricity price rises, the Scottish housing market is showing astounding resilience and is forecast to grow again. Something to watch out for is the fact that in terms of spend, Scottish social security related spend exceeds the block grant adjustment in all years since it became devolved, and child disability caseloads have increased in recent years and is significantly higher than England and Wales, which is rather concerning, and the optics for future taxpayer numbers may be affected by these statistics. So it's one to watch. Now, in terms of the tax strategy document, the government sets out the next steps in the Scottish Government's approach to tax. It says it's building on the 2021 framework for tax to provide certainty and stability for taxpayers and businesses, and for the continued development of our evidence for tax policy into the future. However, it reads to us more like a factual compilation combined with a short-term forecasting arrangement rather than a strategic future positioning paper. And given the parliamentary term ends in spring 2026, it can only really ever be a short-term optic, which is not what individuals and businesses need to bring certainty and stability into their day-to-day affairs. So that's just a little introduction to this, and I'll move straight on to Scottish income tax. So the Scottish Government doesn't intend to introduce any new rates or bands this time around or change the rates for income tax. It's modifying the lower bands. So the two lowest income tax thresholds, the starter rate and the basic rate, will increase to 15,397, up from 14,876, and 27,491 from 26,561 respectively, with a promise to continue to uprate those thresholds by at least inflation for the duration of the Parliament. The higher and advanced and the top rate thresholds will remain at their current levels of 43,662, 75,000 and 125,140. So some key takeaways are that for 25-26, the starter rate band is increasing by 22.6% and the basic rate band is increasing by 6.6%. The result is that the thresholds for paying both the basic and intermediate rates of tax will increase by 3.5% consolidated. And the higher advanced and top rate thresholds are going to be frozen to the end of the current parliamentary term in spring 2026, which, let's face it, once the rates come in and are valid, is for a year. The Scottish Government has committed itself to not introduce any new bands or increase the rates of Scottish income tax until the end of the parliamentary term, other than as stated above by a minimum of inflation. But they will maintain a commitment that over half of Scottish taxpayers will pay less income tax than they do in the rest of the UK. So that is that really. So I'll just show you our famous, which must be now world famous surely, the ICAS Ready Reckoner that we produce every budget, every Scottish budget, which helps us to work out, the comparator between Scottish income tax and the rest of the UK, which obviously includes Wales, and I'll move on to that later. But the Welsh rates and bands are the same as the English and Northern Irish ones. So the Scottish Government's income tax proposals mean, as you can see from my little highlighted boxes there for ease of reading, is that all taxpayers earning below 30,400 this year, in the coming tax year that is, will pay less income tax in Scotland than they would if they lived elsewhere in the UK. However, the differences are small for this group of taxpayers, so it's only £28 a year. So for those earning above this amount, the gap between what they pay in Scotland and what they would pay elsewhere in the UK widens ever more rapidly as earnings increase, and that's due to the progressive income tax rates and bands that have been brought in. So those earning 50,000, I've highlighted that one in green, will now pay around £1,500 more in Scotland than they would elsewhere in the UK, while someone earning over 150,000, which is in blue, will pay almost £6,000 more over the course of the year. And according to the Scottish Fiscal Commission and the Office of Budget Responsibility, the Scottish budget is better off by 838 million because of the partial devolution of income tax and the choices made by the Scottish Government. However, the Scottish Fiscal Commission did also point out that Scottish income taxpayers pay 1,676 million, 1.6 billion more in income tax in more in income tax than their counterparts in the rest of the UK. But the Scottish budget, due to the Barnett formula, etc., is only benefiting by 838 million and not the 1.6 billion. So the Scottish Fiscal Commission call this the economic performance gap. And Fraser of Allender Institute tells us that this also matters for future budgets because the size of the budget is partly based on forecasted tax revenues in Scotland and the rest of the UK. And the reconciliation is then applied to future budgets once actual tax revenues are known. And when the 2024-25 budget was set, the income tax net position was forecast to be 1.4 billion. Since then, the OBR's projections of 2024 income tax, 2024-25, income tax revenues for the UK have increased by more than the Scottish Fiscal Commission's equivalent for Scotland, which suggests the eventual income tax net position for 2024-25 will be smaller than was forecasted when the budget was set. So if that rationale is borne out, the Scottish Fiscal Commission now projects a negative reconciliation of 701 million, which would be applied to, which means it would be deducted from the 2027-28 Scottish budget. The Scottish Government does have limited borrowing powers to smooth out the effects of reconciliations, but 701 million exceeds the annual borrowing limit for forecasting errors. So yesterday I attended a post-budget update by the Scottish Fiscal Commission, and the key messages were that there is a stronger outlook for both UK and Scottish incomes, but the projection of income tax receipts for Scotland has been revised downwards by the Scottish Fiscal Commission by 0.9 billion for 25-26. And it's a known fact that there is bigger growth in earnings in the rest of the UK than in Scotland. So the UK increased tax receipts are having a negative effect on the Barnett funding arrangements because under the fiscal framework, Scotland only gets more funding if it performs better than the rest of the UK in the devolved taxes piece. There's a huge differential in that Scotland has a bigger public sector than England does, which suppresses relative earnings, because the larger private sector in England is experiencing faster earnings growth and thus higher tax receipts. Once again, we'll have to watch and wait, but clearly the Scottish Government must spin many plates to make it all work. So having said all of that, I shall move on to the next slide, which is about land and buildings transaction tax. So in early 2025, a consultation on draft legislation to provide relief from land and buildings transaction tax on the exchange of units within arrangements known as co-ownership authorised contractual schemes, or COACs, investing in Scottish property was put out, and also a consultation to seek views on the case for introducing an LBTT relief for the seeding of properties from existing unauthorised investment vehicles into property authorised investment funds was released. And in early 2025, legislation will also be laid before Parliament to provide additional clarity on the clawback arrangements for subsale development relief and to provide for the availability of LBTT group relief for non-partition demergers. These issues have been discussed in many roundtables since LBTT first began because it was never included in the original legislative provisions. And the Law Society for Scotland have been instrumental in bringing about these changes with the support of ICAS. We've both given evidence at the Scottish Parliament about that. So there's a policy intent review on this, and the Scottish Government will be conducting a review of various aspects of residential and non-residential LBTT arrangements to ensure that they continue to meet their policy intent or where potential amendments are identified, to be that they will inform decisions by the next Parliament. So ICAS expects to be included in these discussions in the usual way. So as we can see on the slide, existing residential and non-residential LBTT rates and bans are remaining unchanged in this budget, but the additional dwelling supplement will increase to 8% from 6% for transactions with an effective date on or after the 5th of December, which is the day after the Scottish budget announcement was made. So the Scottish Fiscal Commission think that there may be very small behavioural changes as a result of that, but we'll have to wait and see what they are. And the transitional arrangements mean that the increase won't apply where the contract for a transaction was entered into prior to the 5th of December 2024. So that is that. And I shall move on to Scottish landfill tax. So here the standard rate of tax and the lower rate are both being increased, and this is in line with the rest of the UK. It's happened in the UK budget and also in the Welsh, and I'll cover that off a bit later on. So there's going to be a consultation next year about the Scottish Landfill Communities Fund. So that is basically that for anyone that's involved in Scottish landfill taxation. So I'll move on to council tax and non-domestic rates. On council tax, there is not going to be a repeat of last year's surprise freeze. In fact, there is no cap on increases, though the Finance Secretary stated that she saw no reason for large increases in council tax this year. Of course, the decision will be for elected councillors in each of Scotland's 32 local authorities to make, and they may well disagree with that statement. Councils will be acutely aware of the fact that this budget has brought them no more certainty over what extent they will be compensated for the increase, for example, in employers' national insurance they themselves face in the local authorities, or whether they will have to find that funding from their own sources, and that might weigh heavily on any decisions that they choose to make on council tax rates and bans in the coming months. And there was also an announcement of non-domestic rates relief for the hospitality industry, which may seem the same as that announced in England at first glance, but it isn't. It's actually much narrower in scope and only applies to the smallest premises, many of which in Scotland will already be getting full relief anyway, and retail and leisure premises were excluded from the announcement. So the devil will be in the detail. For one, only hospitality businesses will benefit from the 40% relief, excluding retail and leisure premises, but even then it's more restrictive because it only applies to premises that are liable for the basic property rate, those valued at less than 51,000. Most premises in this category are eligible for either partial or the full amount of small business bonus anyway, so the new relief sounds much more generous than it probably turns out to be. And Fraser of Allender point out that this is why the cost of the relief is only £22 million, which is much lower than the 147 million which was generated in Barnett consequentials during the UK budget announcement. The last business rates revaluation took effect on April 2023, on the 1st of April, with a tone date of the 1st of April 2022. So the next revaluation is scheduled for the 1st of April 2026. So from 1st of April 2025, councils will be able to retain 50% of additional non-domestic rates revenue raised from the use of their anti-avoidance powers under the non-domestic rates miscellaneous anti-avoidance measures Scotland regulations of 2023. That's for the first time they'll be able to use them. Excuse me. The main announcements on this focused on business rate reduction for hospitality and small business. And the news that non-domestic rates relief will not be extended to retail businesses has not been particularly well received by stakeholders, and the Federation of Small Business called it a bitter pill to swallow. Retail premises make up roughly a fifth of properties on the valuation roll, actually, yet. So it seems the Scottish Government couldn't risk the additional cost of the relief, which Fraser of Allender are estimating to be about 220 million. According to the Cabinet Secretary, any further reliefs would be unsustainable because the UK government would not fund it. She said, "We only got 145 million this year in consequentials, and there will be no consequentials next year because the UK government is moving to a different business tax rate system that cannot be replicated here." So that's just a little bit about council tax and non-domestic rates. So I just want to talk about national insurance for a second, because the rise in employers' national insurance in the budget had not been factored into forecasts for 25-26. So essentially what happened here was that the Scottish Fiscal Commission's documents, which were published alongside the budget, actually revealed, as a bit of a surprise for us all who were scrutinising them, that the increased cost of employment from the rise in employers' national insurance contributions hasn't been factored in to the plans for next year. And that's a bit weird, really, because the Scottish Government might not know exactly what the level of compensation from the Treasury will be, because it hasn't filtered through yet, but the cost clearly needs to be recognised in the accounts, even if it's just the extra amount from the expected level of cover. Not doing so probably presents something of a risk to the budget plans, and one which has echoes of what happened in this year's current financial year. The Scottish Government then significantly underestimated the wage bill costs it would face, and ended up in a situation where it had to take action midway through the year to rebalance the books. But the national insurance cost is a significant and certain higher fixed cost that will commence on the 1st of April. So will further emergency measures be required? We don't know yet. What lessons have been learned from going into a new year without fully setting aside budget cover for what are known costs, as highlighted by the recent Audit Scotland report, is, we don't want a repeat of what's happened in previous years. So that's just a little point about the national insurance situation that affects Scotland and Scottish businesses. So I'll just move on to some planned new legislation. So I'll look at what's to be introduced in 25-26. In terms of the coming year, a building safety levy in Scotland is being introduced, and that's going to be the equivalent to a levy that the UK government intends to introduce in England. And the Scottish Building Safety Levy will provide vital revenues to support the funding of the Scottish Government's cladding remediation programme. The Scottish Government has intensive work underway to explore a potential cruise ship levy as well. And this is going to be along similar lines, we anticipate, to the existing Scottish visitor levy, or the tourist tax, which has already been introduced as a local tax, and it's up to local authorities to decide whether they want to implement it or not and set the rates accordingly. And the other thing that's being sort of bandied about is the carbon land tax ideas, So nothing fixed has been agreed upon as a way forward for that. So I can't really tell you any more apart from the name of the potential tax, because I don't know very much about it at all, or what it's going to be based on, or anything like that. So now the Scotland Act 2016 gave the Scottish Parliament the power to introduce a devolved tax to replace the UK aggregates levy in Scotland. So the Aggregates Tax and Devolved Taxes Administration Scotland Act, which received royal assent in November 2024, makes provision for key elements of the Scottish aggregates tax. Subject to the approval of the necessary Scottish and UK secondary legislation, the Scottish Government intends that the introduction of a Scottish aggregates tax will occur from the 1st of April 2026. And there's still a few things to be ironed out between now and then. I'm currently attending meetings with them to work on things like the locus of the tax and the rates of the tax and how the tax calculation will be performed. So the Scottish Government remains committed to introducing air departure tax and continues to explore all the options to implement the tax. It's really subject to arguments at the moment. This is the reason why it's been delayed. The legislation came in a few years ago, but it's never been, the red button has never been pressed to activate the tax because there are a few EU subsidy control anomalies that are still hanging over our heads despite Brexit and whatnot. So that is a little bit about some planned new legislation. So I'm just going to have a quick talk about the dangers of short-termism in the tax strategy document, because I mentioned at the top of the webinar about the tax strategy document being published alongside the budget announcement. Fraser of Allender Institute and the Scottish Fiscal Commission and Audit Scotland have recently highlighted the risks of Scottish Government decisions focused on the short term, making choices harder down the line. It's important that these lessons on financial planning and setting aside provisions for known or likely costs are learned and implemented. I don't feel that I can say that this has been the case with this budget. On tax, there have been two significant announcements. One is that income tax thresholds for the lowest bands are increasing with inflation, but not those for the higher rates and above. This has now been continual Scottish Government policy for a number of years and will continue to bring in significant numbers of people into higher rates of tax. Now, that's a political decision, but it is a form of stealth tax known as fiscal drag, and it's become something of a habit in recent years. Scotland wants to continue to be able to say that a proportion of Scots will pay less tax on lower incomes than the rest of their UK counterparts, but that difference is negligible, as we've said before, at just over £20 a year. And what no one says is that all Scottish taxpayers benefit from the 20 odd pounds. All of them, because the band it's built into the rates and bands which everybody transgresses through as they work out their tax computation. So I suppose the obvious question there is it worth it? That's not really for me to say. But as I said, the Scottish Government published their tax strategy alongside the budget, which was intended to set out the steps that will underpin the Scottish Government's approach to developing new taxes and tax policy. In terms of firm commitments, they are limited, and given where we are in the political cycle, they effectively only cover commitments for this budget and the next. In respect of income tax, the Scottish Government is committing to not introducing any new bands or rates, as we know, as well as ensuring that people pay less tax at the lower end of the scale, and that's okay, and that they will uprate the starter and basic rate bands by at least inflation and freeze the higher advanced and top rate thresholds. But beyond the specific commitments that they've made there's a lot of talk within the strategy document of exploring, considering and engaging on a range of taxes, including council tax and non-domestic rates, which I know that we and the Law Society and the CIOT have all been pressing for over numerous years now. There's a commitment to reporting on progress in early 2026. So, given that I've been speaking to the Scottish Government about all of these things for almost a decade, I'd like to see some doing rather than more talking and reporting. But this is what seems to happen when there is only a year left before an election. Indeed, Audit Scotland's noted as well that there is no evidence of large-scale change on the ground, and the Parliament's Finance and Public Administration Committee has expressed some frustration around the lack of any clear action being taken. The budget document talks of setting out a 10-year programme of public sector reform to Parliament with a strong focus on the data, the levers and the workforce that will be needed to drive efficiency. To enable this to work, they've said that they will they'll deliver an Invest to Save fund in 2025-26, which is backed by up to £30 million of funding. But it's hard to see how 30 million will really shift the dial when the budget also notes that health and social care reform is a key element of the approach and showing signs of strain with significant challenges to navigate. So I just wanted to bring out those points within the tax strategy document for those of you who haven't not been able to sleep at night and therefore been reading it. So just a little bit of further reading on all things Scottish budget and Scottish taxes. Of course, every year I usually produce the updated guide to Scottish taxes, the ICAS one. So the new one was published just before the Scottish budget. I don't include the Scottish budget in the guide because obviously it's a draft budget. So the budget is not ratified by Parliament until round about February, March each year. So I can't put that sort of information into the guide because it isn't final. So I'll now move on. And I'm just looking at the time. Yes, it's 11:39, 11:40, so we're doing well. So I'll move on to the Welsh budget because the Welsh budget is trailing behind the Scottish devolved process a little bit, just by a few years. But it's interesting to see and compare the difference in the approach by the two different governments and what they decide to do with their budgets. Now, obviously, the Scottish population is slightly larger than the Welsh. There's a completely different geographical dynamic in Wales. There's a very, very long border between Wales and England. And if you look at the telephone book, you'll notice that the vast majority of people in Wales live on that border. So that tells us that there's a huge amount of influx and outflux between Wales and England on a daily basis where people work in either country. So that is much more significant than the movements between Scotland and England, I have to say. Anyway, I'll move on. So the draft budget sets out the Welsh Government's spending plans for the next financial year, 25-26. That was published on Tuesday, the 10th of December. And in addition to the block grant, part of the budget is funded from money raised from devolved taxes, as with Scotland. And the Welsh Government can also access limited amounts of borrowing, as can Scotland. The budget, being published in its draft form, covers all areas of Welsh Government spending, including health, transport, councils, education, and involves around 25 billion of spending. So it's a smaller budget than the Scottish budget, but nevertheless it's significant. And as a case study, it's very interesting to study what's happening in both places at the same time. So the other significant point here is that because Labour has exactly half of the 60 seats in the Senate, the party needs help from other politicians to pass the budget, which is similar to Scotland, but not quite the same. Plaid Cymru's Helen Fichen has stated that her party does not intend to support it, and nor do the Conservatives, which potentially leaves us with the only Liberal Democrat in the Senate, Jane Dodds, to have a casting vote, if that happens. So if there's no agreement and a budget can't be passed, the First Minister, Eleanor Morgan, says that Wales could lose up to £1 billion of funding. So it's important that all the politicians consider what is truly right for Wales. And so the Welsh rates of income tax, landfill disposals tax and land transaction tax are the Welsh equivalents of the devolved taxes in Scotland. They contribute together around £4 billion to the Welsh budget in 25-26. And the budget's made up of 21 billion of UK government funding, 3.6 million from the Welsh rates of income tax, 1.1 billion of non-domestic rates and 370 million of fully devolved taxes, which is land transaction tax of 338 million and 32 million from landfill disposal tax. The budget includes 150 million of capital borrowing and 13 million planned repayment. And other funding will support transport, housing and local government to create green jobs and growth. So a similar sort of focus to Scotland, but on a much smaller scale. Further details of funding will be announced by the Welsh Government during the course of this very week. And the new 157 million package of funding, which is a combination of revenue and capital spend, is for the current financial year 2024-25. So alongside the budget, a tax policy report is published each year in Wales, and that was published again on the 10th of December. And it reports against the Welsh Government's tax policy framework and tax work plan for that Parliament, which is between 21 and 26. So it sets out progress on a range of activities, including tax-related programmes for government commitments on two specific areas: local government and finance reform and the visitor levy bill, because Wales is also considering the introduction of a visitor levy. So that's just a little bit of information for you about the initial points of note. So what about the tax measures then? So we've got, I've put some links into all these slides where you can access the actual government documents for all the different taxes. But in terms of land transaction tax, I'm going to bring that up first. No, actually, I'm not. I'm going to talk about income tax first. The rates are to stay as they are. There's no change to them. So essentially, the rates of income tax and the bands will be the same as England and Northern Ireland. And that's been the case in Wales since Welsh income tax was actually introduced. They've never chosen to diverge from the UK rates. So that's interesting in itself, and I'll explain why in a bit. I'll move on to land transaction tax. The change to land transaction tax, where we've got an across-the-board increase of 1%, will result in the higher residential rates of land transaction tax being set at broadly 5 percentage points above the main residential rates. And the increase is estimated to raise about an additional £7 million in 25-26, which will increase the funding available to invest in public services in Wales. And the current starting threshold for the main residential rates of land transaction tax will remain at 225,000, still ensuring that around 60% of residential transactions are below the threshold for paying land transaction tax, which is in contrast to Scotland. The forecast revenues from land transaction tax in 25-26, as detailed in the Welsh Taxes Outlook, which was published on the 10th of December, includes 2.6 million of additional tax receipts because of additional resources being invested in the Welsh Revenue Authority to make it more efficient. This will allow the authority to expand its work and to identify and rectify tax returns which seek to underreport tax liability and then enable them to recover those amounts. So changes are being made in the new year by regulation as well to the multiple dwellings relief, or MDR, which is available on the purchase of 2 or more dwellings in Wales. And these changes will ensure that MDR claims won't be allowed where the subsidiary dwelling exemption is applied. So taxpayers subject to subsidiary dwelling exemption would pay the main residential rates on the total consideration without the benefit of the MDR. And that's a first step to improving the regime, which is underpinning the purchases of more than one property in a single transaction. So ICAS has been working with CIOT as well to make sure that in Scotland and Wales, the land transaction tax and the land and buildings transaction tax, respectively, are tweaked as we go along because of the anomalies that we've found to be arising, and that is certainly been one of them in Wales. We understand that they're going to carry out further work to consider MDR relief within the land transaction tax regime over the coming year. So draft regulations were laid on the 10th of December to extend the new land transaction tax special sites relief, which is currently afforded to the Celtic Freeport, to the relevant designated areas of the Ynys Môn Freeport as well. So that is good because it looks as if the Freeport regime throughout the UK will generate additional business, inward investment, and of course jobs, which is always a good thing. So I'll move on to landfill disposals tax, where, as I said before, the standard rate of disposals from April 2025 is going to be in line with the increase to landfill tax in the UK and also in Scotland. And this is done on purpose, of course, to minimise the risk of movement of waste across borders, or waste tourism, as we call it. So Unite the Union, just to offer you an insight into the reaction to this, a budget announcement has said it offers a cautious welcome to the budget. It says it needs time to look at the detail, but does criticise the Welsh Government for not taking any action to offset the brutal cut in the winter fuel payment by the UK Government. So once again, there's a contrast to the decisions taken there with Scotland as well. So we'll see. Now, I think I'm going to move on to some questions because it looks as if I've sort of finished on time, Chris.
Thank you very much, Justine. Yes, it's that time for questions. Feel free to drop any questions in the chat. I've got a couple for you just to start us off, Justine, if that's okay.
Yeah.
The first one was to do with the Scottish budget. I'm just thinking with the particular dynamic that we have that you mentioned in terms of the politics and the number of seats that the SNP has in Holyrood. And they obviously don't have control of the Parliament. So the LBTT change on the additional dwelling supplement, that was taking immediate effect. But there is the potential that the Scottish Government won't be able to pass its budget because of its minority status. What's your thoughts in terms of the practical issues that our members need to be aware of if they're discussing this with their clients?
Yeah, absolutely. I mean, the legislation was introduced. Similar measures, of course, in Wales too. But what we have to remember with both of these budgets is that they are draft budgets. So there is the possibility that the measures can be voted down and not be able to be enacted. So even though the legislation's been introduced there, the actual transitional provisions have been introduced as well. I've always thought it's a bit odd that the governments don't do something from the beginning of the next tax year in the devolved areas, but actually they do tend to choose to bring in things as they go and immediately with transitional provisions and anti-avoidance measures. But there is always the risk that the measures won't get voted through. Now, we haven't really ever had that problem yet, but that's not to say that it won't happen in future. So we have to sort of take account of that. And if people are advising clients, then obviously they need to point out that these are draft measures. But everybody has to act as if they are not until such times as we know that the measures have actually been passed, which is, we're all on tenterhooks really until the measures have been passed next year. But it is a bit of a strange situation, and it is actually exacerbated the complexity of the arrangements and the introduction of legislation in devolved jurisdictions during the tax year, piecemeal, as opposed to doing it through a fiscal event, which might be a kind of a finance act in the equivalent to the devolved jurisdictions is something that ICAS, the CIOT, Law Society, and lots of other people have been asking for ever since devolved taxes first came in, because it just means that us tax bods can, and anybody else who really wants to do a bit of bedtime reading, can actually find everything in one place at one time. So that's really something that we'd like to see happening in future.
Thanks, Justine. That kind of takes me on to my second question on the whole procedure of getting the Scottish budget through. And there are income tax changes that there's the draft resolution for the Scottish rate resolution. If that doesn't go through, the Scottish Government could have a bit of a problem if that doesn't come into has not passed before the 5th of April.
Yeah, actually, quite a lot of people ask me about this. And I was lecturing at Nottingham last week on this particular subject, and I was giving the students an overview of how you might go about setting up a tax regime in a devolved jurisdiction for the first time, give them something to think about. And one of the students actually asked me about this, and we had quite a big discussion on it, because in Scotland there's an interplay between the Scotland Act and amendments to it, and also the Income Taxes Act. And the interplay basically says that if you can wrap a hot towel around your head and actually study all the different bits of it so as you can piece it all together, it actually says that if the Scottish rate resolution on income tax, which as we know is an annual tax, income tax has always been an annual tax in the UK, but a Scottish rate resolution must be passed, otherwise Scotland gets a big fat zero. So actually it's very, very much in the politicians' interest to make sure that Scotland gets that money. Because otherwise, if it reverts to zero, Scotland doesn't get anything. which is a very peculiar thing to
And we're a
happen,
much
isn't
bigger
it?
black hole than anyone would be currently envisaging. So no, thanks for that,
Yeah.
Justine. And I think we're almost out of time there. So
Okay.
thank you for
Right.
those questions. Please remember that you can keep up to date with all the latest tax and other professional news, including the latest guidance and resources on icast.com. You can also access technical support through the ICAST Technical Help Desk, available through the Contact Us section of our website. This includes audit, accounting, tax, practice support, AML and ethics. It would be great if you could leave us a rating for today's webinar. There will be a poll appearing on your screen shortly on the chat box and at the top of the screen. If we really appreciate your feedback, so if you could take a few moments to complete that before you log off, that would be greatly appreciated. Looking ahead, this is our final webinar of 2024, but we have some webinars planned for the new year. The first one is on the 30th of January, when there will be a preparing for financial reporting changes on the charity space. And we also have plans for a VAT update webinar with Tony Cochrane. He's joining us again on the 11th of March. That one's not up on the website, but it will be up shortly. So links to sign up to all ICAST events are, as ever, available on icast.com/events. It only leaves me to thank Justine once again for her excellent insight into the devolved taxes space, and of course you, the audience, for joining us today. I hope that the webinar has been useful to you, and we'd like to, on behalf of ICAST, wish you all the very best for the festive season, and we look forward to seeing you at a webinar or other event in the new year. So until then, it's goodbye. Thank you very much.